Hello and welcome to Star USA Training. Today is Tuesday, May 10th, and we'll be talking about landed costs in international transactions. We are recording the webinar. The slides and the recording and any other materials will be made available after the broadcast. All participants are currently muted, but the Q&A feature, we encourage use of that. Please ask any questions that you like. And as a matter of fact, Joe, do you want to intro the...
Sure.
Yeah.
So after the webinar, Michael will stop recording and then we will do Stump the Speaker, where we try to ask our most complicated questions and see if he knows the answers.
Excellent. Yeah, it's a lot of fun. It's been a pretty popular feature this year. So we encourage you to try and ask some of the tough questions there at the end. Quick note about closed captioning. For anybody having difficulty with the automated transcription, please just let us know via train@starusa.org after the webinar. We'd love to help you understand the materials. There's a lot of initialisms, a lot of acronyms that we use in international trade generally. I tend to speak fast, and this stuff can be pretty confusing even without needing to rely on the transcript. So our teams are more than happy to help. And if you just reach out to us, we would be happy to assist. Also, this webinar is eligible for 1 CCS credit. Please email train@starusa.org after the webinar with your NCBFAA ID number, and we'll get that submitted for your credits. Some quick background on me and Star USA. Star USA is a trade and compliance consulting, advice, training, and services company based out of Northeast Ohio, more than 25 years in business. We do in and outsource trade operations, handle policies and procedure implementation, development, conduct audits and disclosures, navigate all factors of international trade, including HS, origin, AD/CVD, so on and so forth. Help with broker management and oversight. And of course, we provide training in all areas of trade and compliance. So if you are interested in learning about a particular topic or subject, please reach out to us. We'd be happy to work with you on that. My name is Michael Easton. I am the president and general manager of Star USA. I'm a licensed customs broker, and I've been in the industry for more than 18 years now, I believe. Okay, so first up, we're going to be talking about landed cost and the theory behind it, what drives it, and what makes it a useful tool in international trade. So landed cost is more than just the sale price or the purchase price. And we're going to take a look at what that means exactly as we go through the different slides today. But at its core, landed cost is a sourcing strategy or a marketing opportunity. It is the total cost to have goods produced and delivered from one point to another. On the procurement side, this means the cost to have goods delivered free and clear to your location. And on the sales side, that's the cost to produce and deliver the goods from your location to the customer. And we want to use landed cost because it can help us identify that optimal strategy to make good decisions and ensure that we're attaining the right profit margins, the right profitability for our products, or that we're not incurring additional costs when trying to bring goods to ourselves, either for further manufacturing or for resale here in the US. I boiled this down to basically 4 key pricing factors to consider when looking at landed cost. And those 4 factors, and we'll examine each of these in some good detail, are the cost of the goods, the freight and the insurance, customs duties and fees, and taxes. And we'll expand a little bit on how each of these can be kind of blown up to be more than just the words that are on the page. But those are the 4 major groupings that we want to consider. Knowing how to apply these factors, knowing when these factors apply, is a key aspect to being able to determine your landed cost. Since you want to find the price that you're actually going to be paying for the goods that you're buying, or you want to find the price that your customers are being asked to pay, these are essential pieces to actually arriving at that price. And when we talk about customs duties, taxes, and fees, things like that, they can be applied on an FOB or a CIF basis. And I'll talk about that in a moment. So Incoterms rules can come into play with landed costs because Incoterms do divide the costs and responsibilities between the buyers and sellers. And when we're looking at landed cost, that's what we're doing. We're trying to assign and determine what the total costs are going to be to each party in the transaction. You can work with multiple suppliers if you're trying to shop prices by using your preferred Incoterm, but in doing that, you may be actually hiding costs accidentally, and we'll take a look at how that can happen. And you might actually be overpaying for goods or arbitrarily reducing your own profit margins. So when calculating landed costs, you want to typically consider two price options: the ex works price or the delivered price, and they have advantages and disadvantages. Those terms, I'm using the phrase ex works price there, and that has some correlation with Incoterms rules. Delivered price has some correlation, but really you need to have all parties on the same page with what you're talking about when you're asking for costs, when we're asking for prices. Note that I referenced the FOB and the CIF terms on the previous page. I'll use those again throughout the presentation here. These have no correlation with Incoterms rules when we're talking about customs and taxes. FOB and CIF have a reserved meaning when it comes to international trade that is separate from Incoterms rules or from any trade terms. So first, we're going to break down what I mean by ex works pricing and delivered pricing. The ex works price is the raw price of the goods sold as is. This is best used as a contrasting suppliers on a one-to-one basis so that you know what the raw cost of the actual materials are as they're produced. And it sets the stage for identifying the other cost factors that go into determining your landed cost, that are these other pieces of the international transaction. Ex works pricing has a clear and mostly universal understanding. When you ask for ex works price or when you provide an ex works price, the people you're talking to are going to understand that you mean this is just the cost of the goods as they are produced. It doesn't imply that you're going to sell the goods on ex works Incoterms or Incoterms rules. That's a whole separate consideration. When we're talking about pricing in this universe, we're talking about just getting that base starting point so that you can perform your landed costs. With ex works pricing, you get to avoid unintentionally obfuscating other costs that happen downstream in the supply chain, things that go into freight or with other parties involved in transactions, and you get to just that true cost of the goods. It also prevents your supplier from unnecessarily buffering the total charges if they're trying to guess at what the excess costs might be. People will often pad those in order to account for overrun with the premise of under promise and over deliver. And again, ex works pricing sets that stage for true landed cost calculations. Delivered pricing is the contrast to that. This is the cost to deliver the goods to a particular place. It may or may not include some of the key cost factors and will generally include some amount of buffer to cover those unknowns that I was just talking about. So with delivered pricing, you're going to get a bigger number and it's likely to include a lot of costs that may or may not be enumerated in your conversations. Delivered pricing is usually an alternative to determining landed cost. If you're requesting delivered pricing from a variety of different suppliers, you're doing that instead of calculating landed cost. And you might be incurring additional charges within that request that you're not aware of. Whereas if you were to do a true landed cost, you would be able to calculate as accurate as possible what your actual cost is going to be. Delivered pricing does put the burden on the seller to establish all those costs up front, and that goes towards that buffering in that next bullet point here, where they're going to add some additional expenses in there to cover any unexpected occurrences. So at the end, delivered pricing is more likely to result in paying more than expected or paying more than you would otherwise with ex works pricing. Freight costs. So when we're looking at freight costs in the landed cost calculation mechanism, there's three basic factors to consider. There's pre-carriage, main carriage, and on-carriage. Pre-carriage being the transport from the point of origin to the first port of lading, main carriage being transport from the port of lading to the port of discharge, and then on-carriage being the last leg, transport from the port of discharge to the final destination. This applies to all modes of transportation, and we'll take a look at some examples at the end of the presentation. But it works for ocean, it works for air, and it works for truck or rail. You have all three of these things to consider. For some of them, the main carriage may be nil. If you're just crossing a border, there is only pre-carriage, non-carriage, or you can consider that whole thing to be main carriage. Generally speaking, pre-carriage is usually best performed by the seller. They're the ones that are going to have the in-country transportation options that are less likely to be available to a buyer. On carriage is generally best performed by the buyer. On the other hand, as the goods are being delivered in your country, the buyer usually has the best advantage to securing the correct rates and the correct transportation partners. Meanwhile, main carriage can be handled by either party. Basically, all freight forwarders worldwide have the capability to do the main carriage piece, and it's really just a question of who has the best advantage there. So pre-carriage is usually for the seller, on carriage for the buyer, and the main carriage can be done by either. Customs duties. So this is our third factor in the landed cost calculations. And when talking about customs duties, we'll talk about customs fees separately. Customs duties are based on the tariff number of the goods, and each tariff number has a duty rate assigned to it within that country of destination. So customs duties are always paid by the importer, and they are calculated based on a percentage, generally speaking, of the cost of the goods. So you have to know your HS number. In the US, that's going to be the HTS US. You can find that on hts.usitc.gov. Know your full 10-digit HTS US number, and the duty rate is assigned at the 8-digit level. We're going into other countries. If you want to research what the duty rates are for particular goods going into other countries, the U.S. International Trade Administration directs you to the Descartes Customs Info Database Tariff Lookup Tool. And there are links on these slides that will be clickable when you get the handout after the session. And then when talking about cross trades, and cross trades here, I mean trade between two countries that don't involve the U.S., you'll need to do some additional legwork or research to look at what the applicable tariff rate might be in that instance, because it can vary based on what your origin country is, depending on what special programs may be in place. So in addition to the duty, there are often customs fees. And countries can implement any number of customs fees into the import process of the transaction. U.S. customs fees, we have the MPF, which is the merchandise processing fee of 0.3464%. It has a minimum and a maximum that change every year. I think these are the current ones. And the U.S. also has a harbor maintenance fee, the HMF, applied at 0.125%, again, on the cost of the goods. Those the HMF only applies for goods arriving by vessel via seaport, but the MPF applies to all merchandise unless there is a free trade agreement in place. Mexico has a customs fee called a DTA of 0.8%, and that's just a flat 0.8% on all imports unless there is a free trade agreement in this case as well. Brazil has at least half a dozen, I think there's 7 different customs fees that apply, and they apply on various different bases of the calculation process, and they can add up to be quite significant. They even have a special 25% fee on the cost of the freight to get the goods to Brazil. So it's important to recognize a lot of the different pieces that get thrown in here. And also when thinking about customs fees, this is where I tend to group in customs brokerage charges. On the freight costs, I'll lump in the forwarding cost, the freight forwarder's fee, which is not necessarily tied to a specific piece of the pre-carriage, main carriage, or on carriage, but that's where I'll lump that. And similarly here in the customs duties and fees section, I will lump the customs brokerage costs. Customs brokerage costs are usually just a nominal flat fee that apply regardless of the price of the goods. In many countries, there are special import programs that can either be an advantage or a disadvantage to you as an importer. Virtually every country has special import programs that can come into play. There are beneficial ones like trade preference programs and free trade agreements. In the US, we have I think 14 free trade agreements with 20 different countries. And we also have other trade preference programs like generalized system of preferences that allow for reduced duty rates on imports from certain countries. There are also the temporary import program, foreign trade zones, the Chapter 98 provisions that allow for duty-free entry into the U.S., and there are duty drawback programs that allow for a little bit of a recalculation, as you were, of the landed cost. But just as there are beneficial ones, there are ones that are not beneficial, ones that increase your overall spend. Things like quotas, which can come into effect at a period in the year when a quota is met and increase the duty rate from either a reduced amount or a zero amount to a much higher amount, in some cases more than 100%. Anti-dumping and countervailing duties can come into play. These charges can vary widely and apply to not just HS numbers, but imports of particular goods that fit within an HS number. So it's like a sub HCS or a manufacturing process, quite a few other different factors that affect the anti-dumping countervailing. And actually, I'll take this chance to plug our other webinars where we talk about AD/CVD, USMCA, and other duty preference programs, a couple of different webinars for you to check out that will go into more detail that I'm not going to go into here. But there are other restrictions like Section 232 and Section 301 that increase the overall spend that need to be factored in. In the case of 301, we're talking about 25% additional on top of the duty and on top of the cost of goods and all the other factors. Those can be significant. And then there are also partner government agency fees, PGA fees, that can increase your effective duty rate. So you need to be aware of the special import programs and whether they're going to apply. And that starts with having knowledge of the HS number and what the product is and how it was made and manufactured in order to determine these sorts of things. And then lastly, taxes, which can be a significant factor in destination markets. Taxes apply separately from customs duties and fees, and I have them broken out here as a different consideration. Most countries use a VAT or a GST tax to apply to their imports. For example, EU countries have a minimum 15% VAT. Most of them are higher. I believe the highest is Hungary at 27%. Canada applies a flat 5% GST to all imports. There are additional taxes when selling in Canada, like the HST and the PST. But for imports, we're talking about a 5% tax on all imports. Mexico has a 16% VAT. And VATs can range pretty wildly around the world. It's not uncommon to see usually between 15 and 20%. There are quite a few that have 25, and there are some that have below 15, but those are a little bit more rare. And taxes can be applied at different stages or at different calculation points of the landed cost. The taxes can be applied to the price of the goods, to the price of the goods plus the freight, or to the price of the goods plus the freight plus the duty, or several other factors. So you need to kind of pay attention to how taxes apply, not just that they exist, but how they actually get added on. The United States is one of a few countries that do not have an import tax. There are only a handful of those. Okay, I mentioned FOB and CIF countries earlier, and I want to kind of expand what I meant by that earlier. FOB, which has the same meaning as it would under the Incoterms or under the Uniform Commercial Code. FOB means free on board, and CIF means carriage, insurance, and freight. But the FOB countries apply duties based on the cost of the goods and the cost to get the goods to the first port of discharge, effectively. CIF countries, meanwhile, apply duties based on the cost of the goods plus the insurance plus the freight. So there's more layered in. US and Canada are the two biggest FOB countries. There are a handful of others, but most countries are CIF. And it's important to recognize that when selling your goods, because there's going to be a different calculation basis. They have a little contrast here on the right-hand side. We've got $10,000 worth of goods, $3,500 in freight and insurance, and a duty rate of 10%. Using the FOB method, that calculation comes out to $14,500. Using the CIF method, it's $14,850. You know, you might say $350, that's not that big of a deal, but it's 2.4% difference. And at scale, this can be a significant amount of money to a corporation that's trying to either enter a market or trying to secure raw materials for their own use. And these differences can compound with other customs fees and taxes. So that can even snowball beyond that 2.4%. That actually $350 may get several other different fees applied to it, which will help snowball your costs out of control. So it's important to be aware of what types of countries. Generally speaking, if you're not going into, let me go back a slide. If you're not going into the US or Canada, it's pretty safe to assume that it's a CIF country. So key takeaways from this section, the four main cost factors: the cost of the goods, the freight and insurance costs, the customs duties and fees, and taxes. And you will need to find out, in order to do landed cost, the tariff and tax rates that apply, the customs fee structure, and any special programs that might apply, and whether it's an FOB or CIF country. Those can all be significant factors. Okay, so we're going to take a brief look into some of the practical application of each of these things and starting to unpack them a little more, and we'll close out with some examples to see how the calculations add up. So in building out our process, we need to understand our cost of goods and how we ask for that and how we communicate about that. When soliciting or providing pricing, specify the cost basis of the goods. I still recommend Ex Works pricing versus delivered pricing, but in your conversations with your customers, they may request delivered, or your capabilities may not even allow for Ex Works to be a thing to bother with, and you only want to get price quotes on a delivered basis. That's fine. But if you're going to use delivered, make sure that you specify what degree of delivery we're talking about. Are we talking about just bringing the goods to a specific place, transportation, or are we talking about delivered free and clear, which is kind of like a DDP, or delivered duty paid type of price basis? And acknowledge the fact that if you are getting delivered pricing, you're one of two things is likely. Either you're going to have an inflated price, a price higher than you would pay otherwise if you were to do it on a build-up method from the Ex Works basis through to final delivery, or there may be surprise charges along the way that have to be accounted for between you and your supplier or your customer. So it's important to be aware of some of the things that can throw a hitch in the works. You can also consider things like financial instruments and methods of payment that add additional costs. Things like a letter of credit is what I'm talking about here. Those cost some money to produce. And it's important to recognize what those might be, even if they may not be that significant in the grand scheme. For freight and insurance, freight costs are absolutely insane right now, as many of you I'm sure are aware. And it's when looking at freight insurance costs, if we're talking about trying to secure the most advantageous price, using an Ex Works basis and building in the price that you can get for freight versus what your supplier can get for freight is a good way to find a better cost advantage. It's anyone's guess who's going to have the better advantage at any given time. In some cases, it's optimal to be a buyer in the US trying to secure freight coming into the US. In other cases, it's more advantageous to be a seller in Europe trying to sell the goods to the US and being able to secure freight. So there's a lot of different factors that are going on in the freight world right now. And if you're looking for an advantage, one of the best ways is to get multiple quotes using your own buying power or your suppliers or your customers' buying powers, making sure you're doing that. You can also consider joining a shippers association or securing your own carrier contracts if you have the volume to do so. Shippers associations allow you to pool your volume with other shippers and hopefully use that volume to secure a lower price. You definitely want to avoid spot pricing wherever possible. It's much harder to do these days than it was a couple of years ago. You also want to consider securing a global insurance policy to avoid paying for insurance on every shipment. Most insurance underwriters will have the option to write you a global cargo insurance policy. They used to call this, it's gone by other names, I can't think of off the top of my head, but global cargo insurance policy will apply to all your goods from warehouse to warehouse. So that's basically from pickup to delivery. And it's usually at a much lower rate in the aggregate than it would be if you were to secure that on a per shipment basis. It may not be an option for people with lower volumes. It may not be a cost advantage there, but generally speaking, insurance rates are somewhere in the neighborhood of 10 to 15 cents per $100 of value, which can be a great deal versus each shipment getting an insurance certificate written for each one. Customs duties and fees. You definitely want to be communicating with your supply chain partner, your buyer, your seller, to specify the 6-digit HS codes for the products, or if you're the seller, research what the full HS in the country of import is going to be, so that you can start to research some of the duty rates and the customs fees that might apply. And also, obviously, acknowledge whether it's an FOB or a CIF basis. Again, most countries are going to be CIF, but definitely check that. And you can use that tool, that link from the previous slides with the tariff lookup tool. You want to do some research on some of the special import programs that may apply, or consult with an expert. There are additional duty rates for shipping your goods into China. There's a US surcharge on those shipments. There are anti-dumping and countervailing cases around the world against the US. The US has anti-dumping and countervailing cases against countries all around the world. There are a lot of different things to pay attention to, and you definitely want to prioritize those by most significant. I think anti-dumping and some of the Section 232, 301 related things are the most likely and most significant to pay attention to right now. But there are plenty of other special import programs like free trade agreements that will allow you to avoid all duty whatsoever. Again, we have trade agreements with 20 different countries, but each country has their own set of trade agreements with their own set of countries. For exports, you should definitely consult with an expert, or contact your U.S. Commercial Services office near you to help you identify some of the market opportunities and some of the advantages and disadvantages in particular markets. The U.S. Commercial Services office exists to help you export your goods from the U.S. So definitely take advantage of their services. And then taxes. Taxes are generally not a factor when importing into the US, but they may require thorough understanding when trying to access new markets. Taxes are a significant factor. I mentioned between 15 and 20% typically. You want to research the tax structure in the country of destination and identify whether they're calculated on a CIF basis, CIF plus duty, or some other factor. Again, if you're lumping in a 10% duty on top of your CIF, your 16 or 20% VAT is going to be compounded pretty significantly by the additional that duty into the calculation basis. You definitely want to consult with an expert or contact U.S. Commercial Services near you for navigating some of the taxes if you need to unpack that. That can get quite complex, particularly if your customers are asking for delivered pricing and there's a question of who's going to be paying which taxes. Okay, so we're going to move into some math here. Loosely, we're using the basic equation of cost of goods plus freight and insurance plus customs fees plus taxes equals your landed cost. In the cost of goods, we're focusing on unit price and quantity plus your financial instruments. For freight insurance, we're looking at pre-carriage, main carriage, on carriage, forwarder fees, and insurance. And customs fees, we're looking at duty plus customs fees minus special import programs plus special import programs. And then lastly, taxes. That's loosely the kind of universe that we're focusing on here. I'm really just trying to give you a backbone into understanding what sort of fees go into these things. So our first example is going to be an import from a Canadian supplier. We're buying 100,000 items at 83 cents per item from a supplier in Canada with an HTS US 39.20, 90, 99.85. This is just other articles of plastic, catch-all. So the cost of the goods at that price point is $83,000. We have no financial instruments in play, no pre-carriage to worry about, main carriage of $750 to cross the border, no on carriage, forwarder fee of $150, insurance of $100. Duty rate is going to be $0 because of USMCA. The duty rate is applied on an FOB basis. Other fees, we have a $347 NPF fee, which could be waived if the USMCA applies. And this is also calculated on an FOB basis, and a broker fee of $125. Taxes of $0. So you add all those things together and you get $84,472. And the FOB basis that I'm talking about there is applying to the cost of goods and the pre-carriage costs, not the main carriage and the on carriage, which typically don't get tabulated as part of the Canadian import process. So we're going to contrast that $84,472 against an import from Germany for the same items. These are being sold, we're buying 100,000 of them, but we're buying it at 3 cents cheaper. So that's a pretty substantial amount difference. And we're going to look at what the landed cost variance is going to be. So same HTS number, cost of goods is $80,000 versus the $83,000 from before. Pre-carriage is $750, main carriage is $3,200, on carriage is $750, forward fee, yada yada. The duty rate here of these items is 5.3%, coming from Germany, which we do not have a free trade agreement with, and that 5.3% is applied on the FOB price. And then there's an additional $381 MPF and HMF that is also applied on the FOB price, and a broker fee of $125. And again, the FOB costs here are being applied to the $80,000 and the $750 pre-carriage. The rest of the charges are non-dutiable. So despite a higher cost of goods from Canada, the landed cost is lower by about $5,000. We had about $84,000 from Canada and about $89,000 here from Germany. And this is where the contrast between the purchase price and the actual landed cost starts to come into play. Obviously, these are pretty rudimentary examples, but hopefully that paints the picture there. Okay. We're going to contrast now a sale example. This is a landed cost selling 10,000 items at $5 a piece to a customer in Mexico. HTS 39, 26, 90, 99, other articles of plastic. The cost of goods is $50,000, 10,000 times 5. $0 in financial instruments, pre-carriage $750, on carriage $750 because the carriage is split going to Mexico most times. Forward fee, insurance are on there, same as they were before. Here we have a duty rate of $0. That is the duty rate going into Mexico. And that is calculated on a CIF basis. And we have a fee of $0. The DTA fee, the 0.8% that I mentioned before, that is waived because this good is eligible for USMCA in this hypothetical scenario. And the broker fee is $200, and our taxes apply on a basis of CIF plus duty plus DTA, or plus the other fee there. For a total of $8,000, $8,136 in taxes. So our total landed cost going to Mexico is $60,000 and $60,086. Contrast that against, wait, let me do that again. Yep. Can I get there? There we go, another blue. The tax basis, the CIF plus duty plus ETA, is adding up all of the fees that are in blue. All the money that's in blue is what's being calculated as part of the taxes, CIF plus duty plus DTA. We're going to contrast that against a sale to a customer in Japan. Same 10,000 items at $5 a pop, same HTS number going to Japan. Cost of goods is $50,000, pre-carriage $750, main carriage $2,750, on carriage $750. The same fees. The duty rate is 3.9% calculated on the CIF value. And the taxes are 10% calculated on the CIF plus the duty value. And that landed cost is $62,361. So despite a 6% higher tax rate in Mexico, Mexico had a 16% VAT, Japan has a 10% VAT, it's actually lower to go into Mexico by about $2,000. So recognizing how the maths come into play will hopefully give you some insight into how to start to construct these sorts of things. Landed costs can get pretty far afield, especially on the sales side, when you're factoring in a lot of different customs fees that are not familiar to most US individuals. Recognizing how they apply and when they apply will often, you'll benefit from having a direct point of contact with brokers in country or your customer working with their broker in country to help identify some of those costs if you need to figure them out. Okay, that is basically the webinar. We're going to go into the question and answer and the Stump the Speaker segment. As a reminder, you can submit your CCS and CES credit requests to train@starusa.org, and we'll jump on those. And I'm going to stop the recording now. Thank you.